I was standing on the edge of a massive nickel processing plant in Indonesia recently, watching a line of automated trucks move with a precision that felt almost clinical. Next to me was a senior fund manager from London, the kind of guy who usually spends his days staring at green and red numbers on a Bloomberg terminal. He looked surprisingly pale. He wasn't checking his phone. He was just staring at the sheer, vibrating scale of the steel and concrete. In London, we talk about value creation through debt restructuring and stock buybacks, he whispered, almost to himself. But standing here, I realized we've forgotten how to actually build. He had come to Southeast Asia looking for a high-yield play, expecting the usual chaotic emerging market. Instead, he found something that clearly rattled his Western sensibilities: state capacity. While he was used to vetocracies, where building a single railway takes a decade of litigation and environmental appeals, he was watching a new industrial heartland rise in real time. He saw Thailand's cabinet setting inflation targets with the surgical discipline of an elite engineering firm, and sovereign wealth funds quietly dumping Western paper assets to buy up the physical data pipelines and mineral veins of the future. That sudden, jarring shift in his expression from a patronizing investor to a man realizing his own world was undergoing a slow, entropic decay reflects a much larger invisible movement. In 2026, the honest vote of capital isn't chasing digital dreams anymore. It is fleeing the West's financial illusions. This isn't just a market shift, it's a civilizational verdict. We are witnessing the return of physical sovereignty, where the power of a nation isn't measured in digital currency units, but in the relentless, unglamorous work of physical creation. And for those still holding on to the financialized old world, the reality check is going to be incredibly heavy.
That image is. It's just perfect, isn't it?
Oh.
The fund manager, completely paralyzed by the sight of real, tangible construction.
He looked like he'd seen a ghost.
Because, in a way, he had. The ghost of his own world's industrial past. He realized his expertise is in shuffling paper, while the world is being rebuilt with steel. And you're right, this is the core of the biggest shift in global power we've seen in, what, decades?
It has to be. And it's not rooted in, quarterly earnings calls or the next big tech IPO. It's happening in the dirt, in the concrete, in the energy grids.
And mastering the actual process of making things.
Exactly. Okay, so let's get into this. This is more than just money moving east. It's a whole different philosophy of how you run a country, how you build an economy.
Right. For so long, the model was simple. The Global South was told, you dig it up, we'll turn it into something useful.
You extract, we process, we innovate. That was the deal.
And that deal is, well, it's completely shattered. So for this deep dive, that's our mission. We need to map out the architecture of this huge pivot to physical, tangible power.
And we're going to break it down into three main pillars, right?
Exactly. Three interlocking pillars. First, we're going to look at the resource base, the strategic control of foundational minerals, and crucially, demanding they're processed locally.
So locking down the raw materials.
Then second, we'll look at the money. But not just any money, the revolutionary way state capital is being used, how sovereign wealth funds are becoming, almost like surgical tools for national development.
Not just savings accounts.
Not at all. And then third, the most visible part, the relentless construction of physical infrastructure, the energy security, the transport links, the whole backbone of this new model. This is the unglamorous, absolutely necessary work of building the 21st century economy. And it's happening so much faster than most people in the West even realize.
Okay, so if we're talking about physical sovereignty, we have to start at the very bottom. The actual earth, the resources.
The dirt beneath our feet, yep.
We're seeing this really powerful and coordinated push from resource-rich nations to basically take back control of the future supply chain.
It's a complete paradigm shift. They're done being the world's quarry. They want to be the factory.
So this idea of resource nationalism, it's not just a political slogan anymore. It's a core industrial strategy.
And the key concept here, the word you'll hear over and over, is beneficiation.
Right. That's a mining term, but it's now a political one.
Absolutely. It just means you have to process the minerals locally. You can't just dig up raw lithium or cobalt ore and ship it out. You have to add value, build the refineries, create the skilled jobs right there. It's an assertion of value retention right at the source.
And we're seeing some really striking, almost aggressive examples of this. Let's start with Tanzania.
Tanzania is a perfect case study. Their Ministry of Minerals just rolled out these sweeping reforms. We're talking about 40 different critical minerals.
40. And the mandate is just, it's non-negotiable, isn't it?
It is. A strict beneficiation requirement, as they call it. The government's message is crystal clear. If you want a medium or large-scale mining license here, you will build the processing facilities on Tanzanian soil, full stop.
So it's not a tax, it's not a fee, it's an industrial ultimatum.
It's forced investment. You want our lithium, you have to invest in our long-term physical capacity.
And this idea translates into financial policy, too. Look at Zimbabwe and its lithium.
Zimbabwe is fascinating. They're pushing this minerals amendment bill, and there are two huge parts to it. First, the government just takes a stake in any major project. Standard enough. But the second part
is what really gets at this idea of physical sovereignty.
It's brilliant. They've put a 5% royalty on lithium exports. But here's the twist. Half of that royalty has to be paid in physical lithium ore, not cash.
Which is it's such a powerful move.
It is. Think about it. Paying the state in the actual resource itself, you immediately sidestep currency volatility, you bypass the whole mess of global commodity markets. Zimbabwe isn't just taxing the revenue from the lithium.
They're building a stockpile, a strategic reserve.
Or an industrial feedstock for their own future battery plants. It forces the mining company into a deep, unavoidable physical partnership with the nation.
That London fund manager, the guy from the intro, he'd see that as a horribly inefficient tax.
Of course he would, because he thinks in spreadsheets. But the leaders in these countries are thinking in tons of processed material. They're taking back control piece by physical piece.
And in some places, it's even more direct. They're just banning raw exports altogether.
Exactly. Forcing a complete pause. Forcing companies to rethink their entire investment model from the ground up.
Namibia is probably the best example in Africa right now. A complete ban.
Complete ban, yeah. On unprocessed lithium, graphite, cobalt, manganese, and rare earths. It's an incredibly broad and decisive move.
And did it work?
Instantly. You saw with the Chinese-owned company, Jinfeng Investments, they had to pivot and fast.
So they moved up the value chain.
They did. They started producing lithium spodumene concentrate, which is a step up. But they haven't gotten to the final stage yet, to fully processed lithium carbonate. So the ban works as this industrial lever, but it also shows you the challenge, right?
Yeah.
Technical gap is still there.
But the pressure is on.
The pressure is relentless.
The really interesting part about Namibia, though, is the geopolitical game they're playing.
The tightrope walk, yeah.
They're the only country in Africa with a ban this strict that has also joined the Mineral Security Partnership, the MSP, the US and EU-led group.
It's an incredibly savvy move. It's a delicate balance. On the one hand, they're asserting total control. This is ours. You will process it here. But on the other hand, they're signaling to the West, we're open for business, but you have to play by our new rules.
So they get the physical independence while inviting Western capital to come and compete with China, but on Namibia's terms.
Precisely. It's a masterclass in playing the great powers against each other for your own national benefit.
Yeah, and we're seeing similar moves, maybe less absolute, but the trend is clear across the continent.
Look at the DRC, the world's biggest cobalt producer. They banned raw copper exports back in 2022. Now, they haven't done a permanent cobalt ban, but they did temporarily suspend exports early in 2025.
Why? What was the goal there?
To stabilize prices, sure, but more importantly, to force contract renegotiations and to push for these regional processing hubs. It's all part of the same playbook.
And it's not just them. It's Ghana, Nigeria, Uganda,
Cameroon, Senegal. They're all looking at this. Stricter export controls, demanding the state gets a piece of the action. The direction of travel is unmistakable. Maximize local value, minimize foreign control.
Okay, so that's Africa using export controls and these clever royalty schemes. In Latin America, though, they're going a step further with lithium. They're using outright state ownership.
Yes. The lithium triangle, Chile, Argentina, and Bolivia, this is really where the ideological battle is being fought.
And Chile is a huge player here.
Huge reserves. And in 2023, they launched their national lithium strategy. The core of it is a massive signal to the market. The government must be a participant in all new lithium projects.
That has to be a major deterrent for, purely speculative Western capital.
Oh, a huge one. Private equity funds, venture capital. They hate having a mandatory government partner. It slows things down, it caps their upside, it ruins their quick exit strategy.
But the Asian players are different.
They operate on a completely different timeline, a state-backed timeline. Look at China's Tianqi Lithium. They already had a big stake in SQM, the state-owned miner. For them, this new rule isn't a deal breaker. It's just a new condition. They adapt, they stay engaged, because they're in it for the long haul.
Mexico went even further, right? They just nationalized the whole industry.
Yep. In 2022, they created Litio X, a state-owned company, to control everything. It takes private speculation out of the equation entirely.
But the most telling example, the one that really gets back to our theme of physical creation versus financial illusion, has to be Bolivia.
Bolivia is the perfect example of how a country's development philosophy dictates who it partners with.
So what happened there? They had bids from everyone, including major Western firms.
They did. They had bids from U.S.-backed companies like EnergyX and Lilac Solutions. And these weren't small players. They had the backing of Bill Gates's Breakthrough Energy Ventures, BMW's serious institutional weight.
So they had the tech, they had the money. Why were they rejected?
It wasn't about the tech. It was about the business model. It was about the timeline.
Explain that.
The Western venture capital model is all about a fast scale-up and a profitable exit. You get in, you prove the concept, you sell it off in 5 to 7 years. But Bolivia's lithium projects, they require massive long-term physical investment. We're talking processing plants, roads, power lines, things that won't see peak returns for 15 or 20 years.
And the VC model just doesn't work for that.
It's completely incompatible.
Yeah.
So Bolivia looked at the proposals and chose the Chinese, Russian, and European firms, many of them state-backed themselves, who understood and were willing to commit to that long, unglamorous timeline of nation building.
So it was a conscious choice. They prioritized partners who would physically build out the country over partners who just offered a quick hit of speculative cash.
That's the verdict right there. It's a profound statement about what they value. Physical development over financialization.
But this all sounds great on paper. But you raised a really important counterpoint earlier. Resource nationalism is one thing, but actually implementing it is another.
And that is the massive strategic vulnerability in all of this. It's one thing to pass a law saying you must process locally. It's another thing entirely to have the institutional muscle to manage those refineries, to negotiate those multi-billion-dollar, multi-decade deals effectively.
The internal expertise.
Exactly. Many of these governments, they just don't have the deep bench of legal, financial, and technical experts needed to go toe-to-toe with multinational giants and get the best possible terms.
And you mentioned something specific, the China desk deficiency.
Right. It's shocking. Even in countries where China's the #1 investor, the main partner on these huge projects, you'll find that the local government often doesn't have a single dedicated China desk. They don't have a team of officials who are fluent in Mandarin, who are experts in Chinese contract law, who understand the nuances of their business culture.
And without that capacity.
Without that, the policy is just symbolic. Foreign dominance continues just under a different legal framework because the local government can't effectively monitor or manage these incredibly complex operations. That capacity gap, that's the biggest challenge they face in making this dream of physical sovereignty a reality.
So controlling the minerals is pillar one, but that's just the start. You need money, huge amounts of it, to actually build the refineries and the power plants.
State-backed money specifically.
Which brings us to pillar two. This shift in how nations are using financial power to fund their physical ambitions. They're not just waiting for foreign investment anymore.
No, they are directing their own capital. And for this, Indonesia is just the perfect, most dynamic case study. Specifically, the creation of the Indonesia Investment Authority, the INA, back in 2021.
When you hear sovereign wealth fund, you usually think of, a passive savings account for oil money or something.
A stabilization fund, right. INA is completely different. It's explicitly a sovereign development fund.
What's the difference?
It's wholly owned by the government, reports directly to the president, and its job isn't to maximize passive returns in global markets. Its job is to accelerate Indonesia's physical development and fix some really chronic problems in their economy.
And what were those problems? Why did they need something like INA?
For years, Indonesia was suffering from something analysts call premature deindustrialization. Their manufacturing just wasn't growing, and their GDP was lagging behind the rest of emerging Asia, all because their physical infrastructure was so poor.
The roads, the ports, the power.
Exactly. The government realized that just tweaking regulations wasn't going to cut it. They needed a direct state-led intervention.
So they mobilized their state-owned entities, their SOEs, as agents of development.
Right, and they pumped massive amounts of cash into them. Capital injections went from around 16 trillion rupiah a year in the early 2010s to 70 trillion by 2020. These SOEs were tasked with building everything.
But that led to another problem.
A huge problem, the deleveraging crisis.
Break that down for us. What does that mean in simple terms?
It means the SOEs took on a terrifying amount of debt to build all this stuff. The debt-to-equity ratio for a major construction SOE like Waskita Karya It shot up from 3.2 to 5.4 in a single year.
So for every dollar they owned, they owed more than $5.
Exactly. They were on the verge of collapse. And if they collapse, the entire national infrastructure plan, the heart of their Vision 2045, would grind to a halt.
So the building was working, but the financing was about to break the builders.
That's perfectly.
Yeah.
And that is the precise problem INA was created to solve. Its core function is something called asset recycling.
How does that work?
It's quite clever. INA's job is to step in and buy the attractive completed assets, like a profitable new toll road or port terminal, from these debt-laden SOEs.
Okay.
The SOE gets a huge cash infusion. They pay down their crippling debt. Their balance sheet is healthy again. And now they have the capital to go and start the next round of big projects.
So it's a loop. It recycles the capital from finished projects back into new construction without the government having to constantly inject new money.
It's a self-sustaining engine for physical creation.
But Indonesia still has a problem, right? They don't have enough domestic capital to fund all this on their own. Their bond market is relatively small.
Very small compared to a neighbor like Malaysia. And their foreign direct investment was low. So INA has a second crucial job. It has to attract foreign co-investors.
Which is tough. Investing in emerging market infrastructure is famously risky. So how does INA convince global funds to come in?
It positions itself as the ultimate risk reducer. It basically acts as a shield to hedge all the financial, political, and geostrategic risks that scare foreign investors away. And it does this with some really unique legal powers.
Like what? What are these assurances?
Well, for one, it gets preferential rights to buy assets from the SOEs. So if you partner with INA, you get first dibs on the best, most profitable infrastructure projects access you would never get on the open market.
That's a strong incentive. But the biggest fear is always that your government partner will just collapse or change the rules.
And that's where INA's trump card comes in. Under its charter, INA cannot go bankrupt unless an independent agency proves it's insolvent.
Wait, say that again? They can't be forced into bankruptcy by creditors.
That's right. It's a radical level of legal protection. It shields the fund, and by extension, its co-investors, from the #1 risk of emerging markets.
Yeah.
Your main partner suddenly disappearing or being bankrupted by a political rival. It totally changes the risk calculation.
And I assume for really sensitive areas, the state keeps control?
Absolutely. For things like oil and gas or drinking water, INA has to keep a majority stake in any joint venture. This guarantees that the core national assets serve the national interest first.
So how has the world responded?
State-backed funds love it. They get it. You've seen money come in from the US, Japan, the UAE, and crucially, China's Silk Road Fund signed on for up to $3 billion. State capital understands state capital.
But what about the big private players? The Blackstones, the BlackRocks?
They've been more cautious. And the reason is that dual mandate we talked about. INA is a development fund. Its goal is socioeconomic transformation, not just pure profit.
And private equity just wants the profit.
They want clear, predictable, market rate returns quarter after quarter. They're not in the business of nation building, so there's a bit of a philosophical clash there.
Which is the perfect bridge to Malaysia. Because with their fund, Khazanah, we see a much more mature version of this state capitalist model.
Khazanah is the blueprint. They've been doing this since 1993. It's highly institutionalized. The prime minister is the chairman. It shows you what INA could become in 30 years.
And their whole strategy is aligned with the National Economic Plan, the Madani Economy Framework. It's all about that dual goal, raising the floor and raising the ceiling.
Right. Inclusive growth for everyone while also making the whole economy more competitive. And they have a specific tool for this. Their impact fund, Dana Impact.
This isn't just a small side project, is it?
Not at all. It's a RM6 billion commitment.
Yeah.
That's serious money. And it's specifically aimed at projects that create measurable socioeconomic value, not just commercial returns. It's capital being used as a surgical tool for a national purpose.
And what are they targeting?
The critical stuff. Digital society, food security, energy security, health, education. In 2023 alone, they put over RM 800 million into just the digital and startup ecosystem. They're building the industrial base of tomorrow.
And they seem obsessed with governance, which is a direct response to the corruption fears that often plague state-owned enterprises.
That's the key to their longevity and success. They have this robust governance framework, this 3 lines model of oversight. It's all about accountability. It's how they earn the trust of the private capital they need to partner with.
And they're walking the walk on sustainability, too.
Absolutely. They became carbon neutral in their own operations in 2023. But more importantly, they mandate ESG-linked KPIs for the leaders of all their portfolio companies.
So if you're a CEO of a company Khazanah owns, your bonus depends on hitting environmental and social goals.
Exactly. It sends a powerful signal that these national goals are non-negotiable. They built this financial fortress, and its sole purpose is to protect and enable this new era of physical creation.
Okay, so we have the resources locked down, and we have the state capital mobilized. Now for pillar 3, the most visible part,
Yeah.
actually putting steel in the ground, building things.
This is where the vision becomes physical reality. And Malaysia's energy transition is a massive example of this.
The National Energy Transition Roadmap, or NEOR.
Right. And Khazanah isn't just a passive financier here. It's playing the role of champion, actively driving the country towards its goal of 70% renewable energy and net zero by 2050. This is a generational infrastructure project.
And they've set up a specific platform for this, UEM Lestra.
Yes, a subsidiary focused entirely on executing this transition. And their focus is on what they call immediate foundation technologies.
Meaning
The stuff you need to build right now. Renewable energy plants, battery storage, EV charging networks, waste management facilities. It's all physical construction, and they are moving incredibly fast.
So give us an example. What's a project that shows this in action?
The big one is in Johor. They're developing a 1 gigawatt hybrid solar power plant. But it's not just a solar farm. It's being built integrated with a brand new renewable energy industrial park.
So you build the power source and the factory to use the power at the same time.
At the exact same time. It's vertically integrated economic planning. Think of the coordination that requires. You have foreign partners from China, local partners, all orchestrated by the state to create a self-contained green industrial hub. It's the opposite of a slow, fragmented vitocracy.
And it's not just new platforms. The big existing state-owned companies are all in too, like Tenaga National Burhead, the grid operator.
TNB is in the trenches. In 2023 alone, they invested nearly RM8 billion just upgrading the existing grid. This is the unglamorous critical work.
The wires, the substations.
All of it. You can't just plug a gigawatt of solar into an old grid. You have to modernize the entire physical network to handle it. It's arguably harder and more important than building the solar farm itself.
And they're building storage too.
That's the flagship project. A 400 megawatt hour battery energy storage system, or BESS, is coming online by 2025.
Why is that so important?
Because solar's intermittent. When the sun goes down, you need massive batteries to keep the lights on. A 400 milliwatt game battery is a huge physical commitment. It's what makes the 70% renewable target physically possible, not just a nice-sounding goal.
And this physical build-out extends to transport, to stitching the region together.
Yes, under TNB's solutions pillar, they're building out EV charging infrastructure. They've partnered with a company called Charge Plus, and the goal is a regional network of 30,000 charge points across Southeast Asia by 2030.
So this is building a physical internet for cars.
That's a great way to put it. It's about regional connectivity, not just a domestic transition.
And we also see them turning waste into energy with companies like Synergy.
Synergy is fascinating.
Yeah.
Their flagship project is a partnership with Felcra, the big agricultural agency. They're building the country's largest biogas-to-energy plant in Pahang.
And the fuel source is waste from palm oil production.
Exactly. Palm oil mill effluent, or POME. It's a highly polluting waste product. Instead of dumping it, they're now converting it into 5.5 megawatts of power.
Turning a huge pollution problem into a power source. That's that physical value creation the London fund manager had forgotten about.
It's the definition of it. And they're aiming for 200 milliW of these kinds of assets by 2024. It's highly targeted physical construction that solves multiple national problems at once.
And if we look back at Indonesia, their physical targets are just as ambitious, all tied to this Vision 2045.
Right. Their goal is to be the world's 5th largest economy by their 100th anniversary. And they're not governing by wishful thinking. They're governing by engineering targets.
What are some of those targets?
They're incredibly precise. Increase manufacturing share GDP, expand the toll road network from about 1,500 kilometers to 2,500, expand the rail network from just over 6,000 kilometers to nearly 7,500.
These are just staggering numbers, especially for a country that's a massive archipelago.
It's the ultimate test of state capacity. And the way they'll measure success isn't by a stock price, it's by kilometers of track laid and tons of nickel processed. It's a completely different worldview.
And Malaysia gives us one last example of this with the Iskandar Development Project. This is long-term, patient state capital at work.
Iskandar Malaysia shows the multi-decade view. Since 2006, Khazanah has been pouring investment into this region. building not just roads and ports, but entire townships, universities, even a film production studio.
So they're building an entire ecosystem, not just infrastructure, but the human and creative capital to use it.
Which proves the point. These sophisticated financial tools, the SWFs, they aren't the end goal. They are just the engine. The engine designed to fund the ruthless, disciplined, long-term work of physical creation.
So if you tie it all together, what we're seeing is a comprehensive strategy. Lock down the raw materials, mobilize state capital to fund development, and then relentlessly build the physical infrastructure. It's all designed to break their dependency on Western financial markets.
It is. It's about achieving genuine economic sovereignty. These SWFs are not acting like hedge funds. They're acting like national architects, absorbing risk, directing capital, and focusing entirely on concrete physical outputs.
It really is the triumph of the builder over the banker, isn't it?
It is. And that's civilizational verdict from the beginning. It's the dawning, heavy realization that real, lasting power is flowing back to the nations that can coordinate the messy, difficult, unglamorous work of making and building things.
And for the world that only knows how to do debt restructuring and stock buybacks, that world feels incredibly fragile right now.
It's precarious. It's completely detached from where future wealth is actually being created. The foundation of global power is shifting back to the physical world, and its gravity is only getting stronger.